Good morning, everyone, and welcome to today's webinar. I'm Simon Denton, your host and chairman. Very warm welcome to you all. We've got over 220 registered to the webinar, so thank you very, very much for taking the time to register, and welcome to those that have arrived early. And that's why we've opened the channel of communication. And we hope to be starting on time, as you would expect, 9:30. So we've got quite a lot of content to get through. And when I turn to the second page, you'll see our sort of ambitious agenda cantering you through three parts of the webinar. So I'll make the formal introductions in a minute. But thank you to you all for arriving early, on time, and a very warm welcome from RPG Crouch Chapman, represented by Michelle and Paul, and from Sovereign, Stuart Stobie, and myself, Simon Denton. So I'll get through some of the housekeepings on time, starting a little bit ahead of schedule, so we can keep to the agenda, not running over by much, I hope. And I will try and deliver some questions to the speakers, especially if they can be answered quickly during the presentation, especially questions that deserve to be answered as we canter through the pages. But there is a questions and answer session in part 3, ladies and gentlemen, and a dedicated amount of time will be allocated for questions and answers. So please register your questions. I've got my right screen open for questions, and Jess from our marketing team will be delivering the questions as we go. So don't be too shy with your questions. The easy ones will be answered promptly, and the more sophisticated ones we can leave to the Q&A session. Any questions we don't get answered, we will answer by email. And so we look forward to receiving those throughout the webinar. So welcome again to you all. I'll resume in a minute's time. Once again, ladies and gentlemen, very, very warm welcome to you all, and thank you for those who have come in early to the webinar room. And again, thank you for all registering. We have 229 registered on today's webinar, so thank you for your dedication to attending this webinar. We've got quite a few joining as I speak, so if you don't mind, I'll just do one or two formalities so we can get started on time, because we've got quite a lot to get through, and an ambitious agenda, which I just mentioned to some of you a little earlier. We last did a webinar on the 30th of September, which was the taxation of UK property and navigating the new landscape. And this webinar nicely complements the one that we delivered a month ago. So those that did not attend the last webinar, and anyone wanting the presentation on the taxation of UK property, just register you, send us an email, and that presentation can be sent to you as well. This presentation will also be sent to you in the next 24 hours, if not today. And so again, stand by to receive an email on that. What we're covering today, ladies and gentlemen, is the UK market entry, UK foreign direct investment, and still the positive UK fiscal landscape for corporate and individuals. So that sort of sets the scene. A webinar delivered by associates at RPG Crouch Chapman and by the Sovereign Group. So page 2, please, Stuart. Right, that's what we're going to get through, ladies and gentlemen. 3 neat sections of today's webinar and an ambitious part 2 covering a number of characteristics and topics. Do raise questions as we canter through multiple slides and to all speakers. So introducing the speakers, my colleague Stuart Stobie, who actually joins us from the Wirral in the northwest of England and has been involved in the trust and fiduciary business and industry for the last 20 years, starting his career with Grant Thornton in Hong Kong before joining our sister headquarters at Sovereign in Hong Kong, where he was the managing director of that sister headquarters. He moved to become the managing director, like I was once upon a time, at Sovereign's largest office and subsidiary in Gibraltar. He moved to be a private banker, a brave decision, working for Coutts in Zurich before we welcomed him back in 2018, where he's based in the northwest of England. He is a member of STEP and has a varied career in financial and the fiduciary services. We're joined today by our special guests, the accountancy firm of RPG Crouch Chapman, a mid-sized specialist firm represented by Michelle O'Brien, a member of the Association of Tax Technicians, 14 years of industrial experience, focusing generally on UK taxation, but advises and specialises in how the tax system functions on an international basis. She also has dedicated her time in offering strategic advice to life science technology sectors. That's probably why she lives in Cambridge as well, where she has specialised in venture capital, R&D, tax credits, patent box, share incentives, and mergers and acquisitions. And you will see in part 2 that's getting quite a bit of coverage. Our other and last speaker, aside from myself, is Paul Randall, the managing partner of RPG Crouch Chapman, a member of the Institute of Chartered Accountants for England and Wales, and has a vast array of experience, especially with clients working from 0 up to 100 million, AIM listed and private equity backed clients. Myself, some of you don't know me, my career started in the fiduciary sector and industry in Andorra. I moved to Gibraltar in the 90s, became the MD of our largest subsidiary, like Stuart did a little later, and was also a member of the global group board of Sovereign. I founded the London office and was the founding MD of our UK operations back in the 90s when I moved back to the UK, a speaker and lecturer on international tax planning, asset protection, corporate migration and retirement planning. And when I have some spare time, or did have some spare time, I am an international cyclist and once was a professional squash player. Enough of that. So that, ladies and gentlemen, completes the topics in which we're going to cover. Do ask questions. And if we go to the next slide, Stuart, I'm just going to start by why consider the UK, setting the scene, setting the speed of this, setting the speed of this seminar. I'm just making sure you can hear us okay. Yes, good. The UK, despite the challenges we face, be it COVID, Brexit, and an uncertain future, we still have the world's leading financial centre, UN Security Council, Premier Nation, founder member of NATO and Commonwealth. You've got all the topics there and why we are a force to be reckoned with. We must promote and boast the fact that we've got the world's best National Health Service, and we pay tribute to those that are committed and working with them, especially in this challenging period, notwithstanding that education is a natural export. And one of the major headlines and one of the major attractions is our two-pronged tier tax system that welcomes non-UK nationals, better described as non-UK domiciled individuals. And that has been in legislation for the best part of 100 years and is majorly attractive, which is what Michelle, Paul and myself will come to talk about at the moment in due course. So not taxed, an incoming person that is not a UK national is not taxed on their worldwide income. And again, we'll be talking about that a little later. Current inflation 0.5%, very competitive. Even unemployment rate also pretty good, positive at even during COVID at 4.1%. And the base rate has never been lower. So, which is why we said in our UK property seminar or webinar, if you're going to buy an attractive property, even secondary property, use the mortgage finance capabilities because it's never been any cheaper. Stuart, next slide, please. Immigration. One should not listen to the broad media when we say that there is no future or little future or an uncertain period, even for EEA, that's European Economic Area, nationals and Swiss nationals. Those that have, there are 2.53 million EU nationals still living in the UK, and if they've lived in the UK for the last 5 years, unless they have not done so already, then please apply for settlement visa. You can actually do it on your phone. There's an app that's a HM Home Office, or talk to Sovereign, because settlement status gives you indefinite leave to remain, indefinite right to live and work in the UK, and I would suggest that you get this done before Christmas and before the end of the year. There is no need to depart. There is no need to have a second country to turn to. No one is getting kicked out or their benefits curtailed, far from it. Those persons that have not lived in the UK for the last 5 years and are thinking of coming to the UK, or might have just arrived in the UK and uncertain about the future, perhaps because they're reading the wrong newspaper and the sensational media, you only have to be here for 1 day in the last 6 months. And I'd say that that is on point until the end of the year in order to claim and apply and claim pre-settlement status. And it's not complicated. 1 day in the last 6 months gives you pre-settlement status, which can be extended to full settlement status. And still, when you enjoy this status, you have full rights to indefinitely live in the UK, full rights to claim and enjoy the non-UK domiciled system of taxation for up to 15 years. So this is good news for EEA and EU nationals and Swiss nationals. Next slide, please. Sure, thank you. Tier 1 immigration visa, the application for this is non-EU nationals, ladies and gentlemen. It's a fast track, the premier of all immigration programs. It takes 2 months to acquire if your housekeeping and paperwork is in place. The term of the visa is 3 years renewable, renewable for a further 2, which enables you to get indefinite leave to remain, the next best thing to a British passport after 5 years, with the right to apply for a British citizenship after 6. But once you acquire the visa, you have all the rights of a UK national, a UK domiciled and resident person, a UK citizen, and the benefits extend to spouse and children under the age of 18. Not everyone has £2 million to invest, but the criteria is you must invest 2 million into active trading companies or establish a new business, a new company owned and managed perhaps by the applicant, and the investment must be maintained for the duration of the visa. Again, applicants after, in this case, 5 years can apply for indefinite leave to remain, and still, ladies and gentlemen, up to 15 years, regardless if one gets a passport or not. Passport is not a determination of domicile or worldwide taxation. We don't have an American system of taxation, which is pretty draconian. You're not taxed on your passport in this country, and for non-doms, you can live in the UK for 15 years or up to 15 years out of 20, enjoying non-UK domicile status, enjoying the benefit of even creating trusts for ongoing and future tax planning. Next slide, please, Stuart. Those that do not have the 2 million available, and not that many do, the next visa, which is more entrepreneurial, is and still applicable to non-EU nationals and persons that do not have to find a requisite amount of minimum capital. Fast track status can be acquired in terms of obtaining this visa, so 2 months like the Tier 1 visa, and the term of the visa is no different to what I've just described in the previous slide. The applicability again is not just for the entrepreneur, it extends to the applicant's spouse and children, but the criteria here, ladies and gentlemen, is the applicant must be employed by an overseas company. We last did one for a Turkish company, and the applicant was working for a Turkish manufacturer. It was a family business. The applicant had a minority percentage of share capital, so the applicant must not be the major shareholder, they must be a minority shareholder, but at least they must be employed and earning actively as an employee of the overseas company. The overseas company can pass a resolution and decide to set up a company in the UK, which is why it's called a sole representative visa, because the UK company is going to represent the overseas company, a bit like how perhaps Sovereign is structured and other companies are structured around the world. The applicant joins the board of that new company, which is something that we create and set up, and therefore that applicant, after he joins the company as a board member and the shares are issued to the overseas company, in this case the Turkish company, that qualifies for sole representative visa status. Set up a subsidiary, not a branch, and the same subsidiary has the same benefits as a regular UK company, and it can still access the local allowances and all the tax benefits that Michelle and Paul are going to explain in a minute. So that's fast track status, business entrepreneurial, no minimum capital investment. Next slide, Stuart, please. Innovative visa, we'll just canter through this. This is not my favorite. It replaced, unfortunately, shouldn't have replaced the Tier 1 entrepreneurial visa. The reasonably fast track, the terms are the same. The applicability is the same as I've described before, but the criteria is a little more challenging because the applicant must have an innovative, viable and scalable plan to develop business in the UK. They must contribute 50,000, which is a little less than the 200,000 on the Tier 1 entrepreneurial visa that got removed from HM Home Office, or the politicians removed the Tier 1 entrepreneurial, unfortunately. But the challenge on this is that a UK endorsing body approved by the Home Office, being a UK institution or sometimes a UK financial institution, must endorse the applicant, not just on the application, but throughout the term of the visa, and that can be expensive. So that's immigration sorted, and there's day-long seminars on immigration, but at least you've got the salient features. Next slide, please, Stuart. Another challenge, another challenge, and this first part is addressing the challenges, addressing the perceived barriers. They're perceived because the reality is there's not a lot of barriers. The UK is one of the easiest places to do business. The UK is one of the easiest places to set up business. The amount of FDI, even during the Brexit and the COVID challenges, is still very positive. On UK banking, they don't always get a great deal of press, good press, because it can be difficult to open UK bank accounts, but there are solutions. It's just cutting through the challenges and navigating through the formalities in terms of opening a bank account. There's 600 businesses formed in the UK each year. Many, and nearly all of them, need a bank account. There are currently 3.5 million sole proprietorships, 405,000 partnerships, 2 million active limited companies, and 4.2 million companies registered at Companies House. Many of those have UK banking services. The 5 largest banks are open for business. They're in the slide. 827 billion household deposits, ladies and gentlemen, and a market share of 63%. Many of these banks offer free banking for 12 months. Some offer for 18 months. However, if the high street banking sector is not delivering a service that we expect, which is unusual, but they normally get there at the end by extending services to a new business. The UK fintech industry is a major disruptor, especially to high street banking, offering 24/7 internet banking, fast track opening, high quality customer services, and totally less sensitive and less prejudicial on the shareholders' origins, the shareholders' domicile, split boards, board of directors here and a board of directors in other countries. And the UK fintech industry grew in 2019 to a sizable 48.5 billion and increasing day by day. So do not disregard the importance of this disrupted industry called fintech. Next slide, Stuart, please. Taxation and employment. Again, non-UK nationals that relocate to reside in the UK are relieved from UK personal taxation for their non-UK income, for their non-UK gains, and for a period of 15 years out of 20 if you decide to stay for 15 years. And if you don't, and if you do decide to stay beyond 15 years, although I'm not expecting you to make up that decision now, we tend to encourage people that take the UK seriously, have businesses overseas, have assets naturally overseas, before they come to the UK or during the early years, and certainly less than 7 years out of 9, they set up a trust. Parliament has legislated for the creation of overseas family trusts, and assets contributed to trusts being assets of a non-UK origin settled to an overseas trust company, settled to an overseas trust company with the head of family, the parents being the settlor and beneficiaries, have major tax planning that can be enjoyed, which Parliament has legislated for. No guesses as who the trustees should be. You're looking at them today, but that's an inherent component of planning that is available to non-UK nationals. Corporation tax is one of the lowest in the EU, and employer taxation compared to our French neighbours and other continental neighbours is ridiculously low. Light touch employment laws, low union involvement, no union involvement if I would like, represents a competitive advantage. So that sets the scene. Barriers, perceived barriers, there's no barriers. Reasons for entering the UK. We're now on to part 2, ladies and gentlemen, and I welcome in Paul and Michelle. Thank you.
Hello, thank you, Simon. Right, Advantages for new businesses entering into the UK. The UK is quite a large and dynamic marketplace in its own right and benefits from being an excellent gateway to other parts of the world. Some of the benefits are flexible and business-minded location, accessibility of language, opportunity to raise capital through UK markets, which we will actually cover later on in the slides with regards to some of the venture capital trust schemes that the UK offers. Wide network of tax treaties, top class environment for R&D work, which we'll also cover there with the schemes which the government offers with regards to tax benefits on our qualifying R&D expenditure, and also a credible legal system as well. Next slide, please. Conducting business in the UK. There's different structures which a business can conduct business in the UK. Now, with regards, the limited liability structures are the limited companies or the limited liability partnerships. With those entities, they are a separate legal entity, and with the limited company, they offer shareholders limited liability. And with the limited liability partnerships, the partners get the limited liability, but they're assessed to income tax rates rather than corporation tax rates, which a limited company is assessable to. Other structures are partnership structures, which are assessable to income tax, but they don't offer the limited liability, which a limited liability partnership would offer. And just for individuals operating in their own right, we have the sole traders, which again are subject to income tax in the UK. What structure to operate through will depend on the permanence of the structure coming into the UK, the size of the activity in the UK, also regulatory and disclosure requirements, and also the commercial implications would all need to be considered when looking at what structure to have in the UK. Over to you, Stuart.
Yeah. Good morning, everybody. I just wanted to sort of highlight a couple of examples of utilizing even UK companies where you may not realise the advantages of doing so. For example, the slide you see now in terms of using a UK company as a holding company, and that briefly, as you can see, is to benefit from the UK's wide network of taxation treaties, which number over 130 right now, and that allows for the mitigation of withholding tax received from subsidiaries, and furthermore, there's a very healthy positive treatment of dividends received whether you're resident or non-resident of the UK. Briefly as well, there's also, as you get down at the bottom point in terms of the substantial shareholder section, that is also very beneficial for if you're looking to dispose of subsidiaries from the UK companies. So the UK should be, and as I say, not everybody automatically think of the UK as a holding price to put your holding company. As you can see, there's some various benefits with the extensive DTAs that it has. At the same time, if that's you want a UK presence, you might, without the issues of tax, you might want to consider the UK LLP. And again, you can see the points. Simon said you're going to get all these slides in detail on bunches of time. But basically, the key factor here is that you can have a UK company. The outside world, you're a UK company. This is transparent for tax. And so, for example, you can have two partners, set up in a no or low tax jurisdiction, which receive the profits that flow through the LLP, and you shouldn't extract the clear parameters you have to operate in. For example, you can't source income within the UK. If you do that properly, you can actually mitigate tax. I just wanted to highlight again that but just interceding these two examples, that the UK can be utilised as a low tax jurisdiction for holding structures, of a particular entity. So I'll now pass to Michelle.
Michelle.
Okay, with the certain requirements for a UK business with the audit and accountancy when your UK business is incorporated under the Companies Act. Now, some, depending on the size of the company, will depend on whether a company is required to be audited. Companies which qualify as small, where their annual turnover is no more than 10.2 million, balance sheet is no more than 5.1 million and fewer than 50 employees, will not require to be audited. Their accounts won't need to be audited. But some companies, depending on if they're seeking investment, they may still want to have those accounts audited because investors will want to see that those accounts have been independently audited. Next slide, please. Next slide, thank you. Also, there's company taxation and reporting requirements in the UK. A company that's resident in the UK for tax purposes is liable to corporation tax on its worldwide profits and chargeable gains. A company which is UK resident, a company, when we look at the UK resident in the UK, it's whether when a company is incorporated here or when they're centrally managed and controlled from the UK. A UK establishment, which we mentioned on the previous slide, they will only be liable to the UK corporation tax on trading income arising through that UK establishment. The corporation tax rates in the UK are still quite low at 19%. Next slide, please, Stuart. Other aspects to consider are the payroll and the audit, and these apply to employees. So when a company has a presence in the UK, employees are subject to payroll requirements, and that's where income tax is deducted from their salaries, income and national insurance as well. If someone is economically still employed by an offshore entity and only visits the UK on business for certain days, tends to be below 60 days, certain payroll obligations may not apply and there may be relaxed payroll procedures there. With the auto enrolment, this is a scheme which got brought in quite a few years ago now, that an employer in the UK must put certain staff into a workplace pension scheme and contribute towards it. And those schemes apply where they employ at least one person. And there's limits to this as to what the pension contributions are based on, and they're based on the qualifying earnings. And the minimum amount of contributions that would need to be made under the auto enrolment scheme are 8% of qualifying earnings, where the employer would contribute at least 3% of that. Next slide, please, Stuart. Here's where we want to focus a lot more on is the UK offers R&D schemes. For the small, medium enterprises, the scheme which is offered to those entities is very beneficial. And what it gives is an R&D tax credit up to 230% enhanced deduction on the R&D expenditure. And also for loss-making companies, it offers a 14.5% cash credit, cash back. So that benefit on that loss equates to about 33.35% of the qualifying expenditure on R&D. Now, HMRC's definition of an R&D is very broad. But basically, if a company is taking on a risk by attempting to resolve scientific or technological uncertainties and making technical ground in doing so, then there's a good chance that that entity would qualify for R&D as an R&D activity. There are two main categories which these are divided into, and these are creating new products, processes or services, or changing or modifying an existing product, process or service. Now, the qualification for a small medium enterprise is that they must have fewer than 500 employees, an annual turnover not exceeding 100 million, and an annual balance sheet not exceeding 86 million. Can we go on to the next slide, please? Thank you. Here we've got the incentives which are offered for the SME schemes and also the RDET scheme as well. We have the RDET scheme which applies to the large entities, and where under that the entities would get a 13% tax credit on their available qualifying expenditure. And that benefit is worth about 11p for every pound you spend on qualifying expenditure. And RDET scheme tends to apply for the large entities which have R&D subcontracted to it, or a project that is subsidised by a grant. So still, even though you may not qualify under the SME scheme, you may still be able to get some form of benefit out of using the RDET scheme. Also, some of the other incentives which the UK offer is the research and development allowance, and that's where a company can get 100% tax relief in a year on acquisition of qualifying capital expenditure on plant and machinery used to carry out R&D activities. What also a company gets, another regime which a company has, is a patent box regime, and this complements the R&D, the SME R&D tax credit scheme. Under this, the patent box, it provides in effect a lower rate of corporation tax of 10% on profits which are derived from qualifying patents and certain similar IP rights. It must have its own qualifying patent or hold an exclusive license for the rights to exploit those patents. There was some legislation which was introduced a few years ago where we've got this nexus approach, where basically the R&D activity needs to be linked with the relevant qualifying patent. Next slide, please, Stuart. We also, on that, the government also offers these grants and these loan schemes as well. So in addition to the subsidiaries which a company can get, a company can also qualify for grants and loans. And what what's doing here is they're offering a number of grants and loan schemes trying to stimulate economic growth for the company and R&D. And there is various schemes, not just these schemes which are on the slide, which the UK do offer to companies when they're looking to stimulate that growth with R&D projects, and also the capital growth and the revenue growth there. Which are quite beneficial if for people coming into the UK looking to generate this additional assistance. Next slide, please, Stuart. On top of the schemes which are offered to companies for R&D related work, we also offer schemes for investors. And what these schemes for the investors do is they help offer good tax relief for people looking to invest money into quite high risk small to medium sized unquoted companies. In brief, the conditions here which apply to investors is that a company or a group must have no more than 15 million in gross assets prior to a share issue and no more than 16 million immediately after. The company must have an objective to grow and develop its trade in the long term, and there must be significant risk to that capital. So effectively, when they're investing, they've got that risk that they may not necessarily get that capital back. A company must have fewer than 250 employees when the shares are issued, and the maximum state aid that can be raised in a 12-month period is 5 million. There is higher limits for knowledge-intensive companies, and there is strict conditions with what companies apply under the knowledge-intensive, but that limit is higher at 10 million. The money which a company raises under the scheme must be employed for the purpose of the qualifying business activity and in order to promote the organic growth, and it must be used within 24 months of issue. If the company fails to meet these conditions in the first 3 years of issue of those shares, or an investor sells those shares, then these tax reliefs will be clawed back. Now, for an investor, the benefits of the tax reliefs which investors get by investing into these schemes is they get a 30% tax relief on the investments that they put in, up to 1 million a year. There is a few years ago, the Revenue brought in a further qualifying criteria that investors must not hold any other shares in the company, and they must only hold high-risk shares, otherwise they won't be able to qualify for these benefits. The investor cannot be connected to the company, so can't be an employee or a director, but there is certain relaxations for business angel directors, which would still allow a director to qualify for this tax relief. Also, with that, investors mustn't have more material interest in the company where they've got more than 30% holding in that company, otherwise they won't be able to qualify for these tax reliefs. Next slide, please, Stuart. On top of the benefits which are offered to investors and also with the R&D schemes, that we also offer quite good schemes for incentivizing employees as well. And what these schemes do is they give certain income tax and capital gains tax advantages to employees. So the main scheme which a lot of UK entities tend to use is the EMI options scheme, and it's very popular among the startups and the established small medium enterprises. What the EMI scheme gives is basically, as long as the shares at grant are issued at market value, there is no pay-as-you-earn implications, any tax or NIC implications when they exercise those options. The growth in value on those shares is subject to capital gains tax rates, which is much lower than the income tax rates in the UK. And if they are still employees at the time when they dispose those shares and they've held those shares for a 24-month qualifying period, they can benefit from a much lower rate of capital gains tax at 10%. So these schemes are much more, these government-approved schemes which HMRC offer to companies for their employees wanting to obtain equity in the company, are much more beneficial than the unapproved schemes which are on offer, because with the unapproved schemes, generally speaking, employees would be subject to income tax on any growth in value on those shares. And those income tax rates are at 20% for basic rate taxpayers, 40% for the higher rate, and 45% for additional rate taxpayers. So as you can see with the capital gains tax rates, we've got the 10 and the 20% rates, so a lot more beneficial for employees. Next slide, please.
Thanks, Michelle. And this slide just shows the basic compliance services that we offer as a firm. And the area I'd like to talk about is the merger and acquisition part in the bottom right-hand side of the slide, which is a very important part of our business. I think if people are looking to come to the UK and looking to identify potential established businesses that they would like to acquire, it is the UK private company sale market is quite closed. We can help identify those targets by doing research in a certain sector, and also once the target's identified, help you with the process of potentially buying a business, with helping source lawyers or other advisors to help you as part of the team to execute on the plan. Another part of that is how to identify the funding to help with acquisitions. We get involved with our clients helping to raise debt funding, sometimes from banks, to help fund part of the acquisition, or we can help raise equity through private equity or some of the venture capital trust funds that Michelle has just spoken about. And that only really applies though with kind of early stage technology businesses. Next slide, please. This is just a good example of the work and the type of corporate finance work we've done for our clients in the last 12 months, really. As you can see, a lot of acquisitions are done in certain sectors where we help with the identifying the target, the due diligence on the target, which means reviewing the accounts and the tax treatment, the history of the business, and also giving advice on the structure of the transaction. The refinances that we get involved with are where there's different types of businesses come together with a current debt provider, and we can help with the forecasting and presentations to another funder to try and get the best rate available for the client, or also perhaps raise more money to help the business grow. Another part of the UK market, which is a little bit unusual compared to other countries, is the junior stock markets that are available. AIM is the most famous one, where it's possible for small and medium-sized enterprises to actually do a float onto the AIM market. You don't have to be registered in the UK, but it is for some businesses that, particularly in the technology sectors, that are quite fast growing and a debt funding isn't really appropriate. AIM is a possibility. It can be quite expensive, but the multiples that you can get on valuation, can be higher, and it does suit some types of businesses. And that's next slide, please.
That's me, I think. Thank you very much, Paul and Michelle. There's a couple of questions coming in, and please raise your questions, especially that part of the second part of the webinar, and raise your questions on anything that Michelle and Paul has succinctly delivered inside 20 minutes, keeping us unusually to time. There is a couple of questions that have come in, which if I can buy some time, I will answer in a moment. But moving on to UK property investment, a barometer for the economy, ladies and gentlemen, and anyone that's needing the seminar notes or the webinar notes for the taxation of the UK property webinar that we held a month ago, which with this webinar complementing the property seminar, please email us and we will send you a copy. But it is a barometer of the economy, and it's a major sector of the economy, the UK property market, valued at 7.93 trillion. I'm not going to count all the pennies and shillings on that one. And the London residential property market surpassing 1.5 trillion, twice the value of the next largest cities, even the one that Stuart is close to, like Liverpool, another sizable one being Birmingham. We can't underscore the importance of the special bubble, the commodity property sector of London. Back to basics, 2/3 of the British households own their own house, with 1/3 being renters, tenants. 47% of house ownership is mortgaged, and those rates in the last few years have come down, haven't they, to an all-time low. £1 trillion is in the buy-to-let market, a major industry, and the UK commercial property sector employs and still employs only 4.1% unemployment in the country, employs 1.2 million people, and contributes 100 billion to the UK economy each year. And with the increase of stamp duty and unfortunate tax laws that are slightly more difficult to navigate around: the commercial acquisitional sector, the property, the land for property, the land purchases for development and trade is a growing, or is a growth sector in the UK property investment marketplace. The average house throughout the country, the average house price throughout the country stands at 252,000. The average London home costing almost double, 484,000 in some parts of London. Good luck at finding one of those, especially in zone 1 to 3. Now, the next slide is one of our better reference slides, so I'm not going to canter you through it a great deal. It's a UK property grid. I'll leave this with you. Should go on perhaps your desktop, and it's applicable to UK non-domiciled persons, or non-doms, those that have not ventured to the UK just yet. They may be non-resident and non-domiciled the UK. Look towards the left-hand side of the black columns, and on the far right-hand side, you've got applications for UK domiciled persons. People like most of the speakers today, I imagine, Paul, Michelle, Stuart, and myself, unfortunately UK domiciled and UK resident. Well, there's less scope in terms of planning. But if we look at how you should purchase, for example, a UK commercial property, and the person is non-UK domiciled or a non-dom of the UK, go right down to the bottom red square. It's UK commercial property. What should you purchase it with? An Isle of Man company, please, because that can be VAT registered within a couple of weeks. A UK company could also be used. And if you move to the third red brick along the bottom, you've got the stamp duty, you've got no ATED, that's annual tax and envelope dwellings, you've got no UK inheritance tax if there's an untimely demise, and you've only got 19% tax on net rental income and gains. That's for a non-dom. Move a little bit further across, you've got the application for UK DOMs using international pensions, and then you've got the application of this slide dealing with property development and how you should invest in that. The buy-to-let rental sector, how non-DOMs and UK DOMs should structure their arrangements. Even a UK main residence for a non-DOM, use a trust if it's over £2 million in value, buy it in your own name if it's not, with a bit of life insurance and a UK will. I'll leave that one with you, ladies and gentlemen, because it's an excellent reference document. There's another question, which I'll leave to later. Next slide, please. We cannot underscore the importance of intellectual property protection. Setting up a company does not give you IP protection. It simply does not. And just setting up a UK company, it may give you the name, but it doesn't give you any advantage in patent, trademark, copyright, and even protecting secrets. So the hallmarks of IP, ladies and gentlemen, is those four salient factors, the four ingredients I like to call it. An invention is usually patentable. Creating a symbol and series of words is usually a trademark. Sovereign has a distinctive trademark. It's got a bit of colour in it, and it has some distinctive features, which is enables us to register a trademark in the UK, in the EU as a community trademark, and certain countries in the world. Copyright, you've got the explanation, and secrets, not just for governments, but IP rights on confidential information. IP protection increases the value of a business. It gives an advantage over one's competitors. Competitors are often too lazy. They may also be too rich, but you have a distinct advantage. An SME has a distinct advantage over a macro competitor if the IP is registered and the macro competitor is not. There's no prejudice on size. It's the first to register their IP. Often a business is not sold to its full capability without IP registration. The purchaser may not be so bothered with the name. It may not be so bothered about the people. That's unlikely, but they are particularly focused on the intellectual property and to exploit that in the future. Every brand deserves IP, but unless it's registered, it can be infringed, copied, lost, abused, and it can force you into a major disadvantage with detrimental financial and other consequences. Nonetheless, major revenue can be generated from the licensing of IP, with royalties paid by a local or overseas licensee, because royalties are tended to be deductible, or the payment of royalties are often deductible for corporation tax in this and in other countries, which is not the case when you pay a dividend. So extracting royalties is often more positive and treated more favorably, and pioneering type of arrangements with licensees around the world. Notwithstanding, the UK has signed the largest network of UK double taxation treaties. I think the second place country doesn't even get into 3 figures. We have signed 130, so obviously we are rather good at doing business with countries around the world and not just our Commonwealth. So with 130 tax treaties signed, reduced withholding tax will apply if South Africa pays a royalty to the UK company. If an EU royalty, a company in the EU pays a royalty to a UK company, and those treaties are going to stay, regardless of what Stuart will tell you about a nice or a hard Brexit. And Stuart's not there to put fear into our lives, but he's coming on to Brexit in a minute. But those treaties are not going to be dismantled. It takes years anyway, and I do not think for 1 minute we are going to be disadvantaged when it comes to the treaties that this country has negotiated and pioneering cross-border trade. So an EU company paying a company in the EU paying a royalty to a UK company is often subject to 0 withholding tax, whereas a non-treaty company paying a royalty to an Australian company, it's 30%. In Switzerland, no, not Switzerland, it's 30%. In the US, it can be something similar, whereas in the UK, it can be 0 or much more reduced, which is why licensing and the registration of IP is so important. Profits arising from UK patents reduced to 10%. In Ireland, it is 6.5%. So you've got the Irish Brexit play as well, which we are rather expert in delivering. That's Republic of Ireland company, ladies and gentlemen. And a UK company can, as Michelle has so well put, obtain substantial R&D credits up to 230%, Michelle, I think. So a major compelling advantage for using a UK company. Stuart.
Yeah, I thought we'd briefly touch on pension structures. Michelle touched on the fact that there is a legal requirement by UK companies for employees to have an enrollment scheme. And you know, basically, if you're over in Italy, there's mandatory funds and similar. There are, of course, also private arrangements that you can put into place. And what you're looking at here is the a brief comparison between a SAS, a small self-administered scheme, and a SIP. It's a self-administered personal pension. Basically, it's sort of, as most of the focus here is on corporate, the SAS would be more applicable to you. In fact, they set up a limited company and the various tax benefits, which I'll come on to in the next slide. At the same time, there is some certain amount of flexibility if you wanted to establish your own pension to have your own say, rather than just, you know, there is options where you place your money into a pension scheme as all very discretionary if you want more say on what your pension is doing and investing in. and then you can set up a SIP for yourself and have a little bit more discussion on what it's investing into and what it's not. If I then move on to the next slide, just a little bit more flexible, so it's probably more applicable to corporates.
Sure. Can you come further forward?
Second,
Come further forward, sir. Just you're cracking up a little bit. It's crackling.
Would impose my face on everybody's screen. So the small self-administered scheme, the SAS, is a type of occupational pension scheme, which the sort of SMEs tend to look after. There's a couple of reasons, as you can see. There's a couple of key ones. One is there's the tax benefits of doing so in terms of relief from contributions by the employer. Furthermore, there, as you can see, in terms of investment strategies, there's a lot of flexibility in what you can and cannot invest into. But with little care, there are parameters on what you can and cannot do. So you need to get professional advice to make sure you're not fulfilled. Otherwise, we send you a bill if you draw down or invest into something which you shouldn't be. So it does allow flexibility for SMEs. And one of the things we see most of here, which is where I'm based, where we minister pensions from, are these assets are buying the commercial property from the principal employer and separating them. So in the event, so you've got a trading company, a warehouse. The warehouse will be acquired by the SAS trading company, which is good. So if it has falls into problems, and that trading company is forced to find that asset in terms of the warehouse is protected because it sits in the SAS rather than being owned by the trading company. Plus, also ignoring that there's a protection structure to it. But also in event that if you're the employer company and you can transfer that in, obviously for the benefit of certain members, obviously that helps build up the pension pots as well. There is also a lend back facility, but again, as I said before, you've got to be a little careful how much you can lend back, and also you have to make sure that it's secured on an asset which is realisable. But again, it does have certain flexibility. Right. I will not be political here. Basically, I just wanted to give you a quick, if you're not aware of it, I know that outside the UK, we're so focused in the UK in addition to the pandemic that we get nothing else but two headlines. Outside the UK, you're probably not so interested in it. But as I say, the UK has left the EU, and we are part, but though we remain part, and we're in transition until the end of this calendar year. So 31st December 2020, we fall out of the EU free trade areas and all that goes with it. We are in negotiation with the EU. You're seeing all sorts of headlines pop up. Most of them political, best to be ignored. But I understand that Mr. Barnier, who's head up the negotiating team, is still based in Westminster. We're trying to work out free trade something. What that will look like, we do not know as we stand. If those negotiations fail, that's when you probably will have the type of breakfast, breakfast and Brexit even will materialise, and that will lead to us in a lot of countries dealing on WTO terms, which not only means increased paperwork, which as has to be said, there will be increased paperwork whatever happens once the UK leaves the transition period is over, because we will still be required to provide documentation to import or export goods from the EU. But if we're trading under WTO, then the tariffs come into play as well, which is why the UK has been negotiating free trade deals with other countries so that they can affect on one. You can see the example of that is with Japan. There are more in the pipeline. What also EU has trade deals with 70 countries, which obviously the UK is currently party to. What the UK has done is gone to those 70 countries and go, on the 1st of January 2021, can we simply roll over that deal? So we're still part of it while we renegotiate, and that's happened in certain circumstances. And then that sort of means the negotiation, full-on taxation agreement, the trade agreement will free trade with these countries will go on. We can still trade freely with these countries. There's also something called the mutual recognition agreements, which have been signed with the US, Australia, and New Zealand. These basically means that if you're, for example, exporting electronic goods to the US, this mutual MRI didn't exist. You'd have to have the good be tested in the US testing laboratories before you could sell it. That is, they accept that our conditions, our standards, our US standards are in line with their own and accept these goods. Frees up trade a little bit, but there's not a full-on free trade agreement. It has to be. So, as I've said there at the end, there are, as you've probably all seen in the headlines, there are multiple advantages and disadvantages of Brexit, and we can go on for that. This is not a political commentary. But this should not, as Simon has really said previously, this should not detract from the UK being still one of the most easiest, flexible, living places to do business. And because of our freedom from the EU, we hope that the red tape within the UK should be reduced. We can only wait to see what the free trade bill looks like between the EU and the UK, and we're hoping it works out. But right now, I still think the UK.
The last part of your talk there was very, very, very scratchy, and I've been told if I could just intervene, we've almost exhausted our time. So, at the request of our monitors, can I just canter through the UK insurance industry, because we've had quite a few dropouts towards the end because the technology wasn't quite right. So if you don't mind, Stuart, I'll just quickly take over, and then we'll go to questions and answers. Because I'm sorry, ladies and gentlemen, the quality of the last couple of minutes was not good. Our apologies. It's not anything to
Stuart.
Insurance industry, we are the largest in Europe. It's a big celebrationary point that United Kingdom insurance industry is one of the oldest industries known to man, lady, dog, and cat. We are the largest in Europe, the fourth in the world, and we have every reason to believe that that will be sustained regardless of what happens in the world going forward. However, we rank in the top 10. No doubt the US is first in being the most litigious countries in the world, getting that unfortunate litigious virus from our US friends. So protection against legal and financial liability claims is apparent. Insurance is endemically important and offering shareholders and customer confidence. Insurance saves resources in time, assets, income, property, and personnel. And it also protects reputation. Cyber insurance is a common threat, protection of people. However, a UK company that is arriving into, or an overseas person or an overseas SME or larger corporate that has designs in regard to entering the UK, setting up in the UK, should always consider the availability of insurance on director and officer policies, professional indemnity, death in service, emergency and evacuation. Not that you should really be able to need to evacuate the UK, but it's very relevant in other countries, in risk countries. Medical, corporate insurance is usually substantially less in cost compared with a private policy, and even down to public liability. The insurance industry is available to all. We do not discriminate, and an SME will find it quite inconsequential in cost to deal with these insurances. Part 3, ladies and gentlemen. Next slide, please. Thank you for your undivided attention. We've still got a major attendee count already, still sustained. thank you everybody for staying on. Thank you for your questions. And one question which I was about to answer, but I quickly got in contact with our Home Office immigration expert, and that is in regard to a person's question from the audience about the status of Hong Kong citizens that have British overseas national passports. And this is a good measure that our Prime Minister has adopted, and is not the only, we are not the only country that are deemed to welcome our Hong Kong citizens into the UK. Currently, the visa rights extended to Hong Kong citizens has increased from 6 months to 12 months. So they have similar rights. A new category is opening for Hong Kong citizens on the 31st of January, relevant to the good question posed by a delegate. And my Home Office immigration expert has just been on the phone to a Hong Kong citizen, and the Prime Minister has made a massive commitment that as from January 31st to be legislated. So don't shoot the messenger, ladies and gentlemen, but Boris Johnson has made a massive commitment that as from the 31st of January, the status and the applicational criteria afforded to Hong Kong citizens is going to be proposed very much like the pre-settlement and settlement status afforded to EU citizens. So that is excellent news. And it is likely that a Hong Kong citizen can apply for a 30-month visa, which will enable them to study, live and work, but not claim the welfare, and then extend for another 30 months, which will enable them to obtain indefinite leave to remain and citizenship thereafter. So good news, a good measure by our government. It's the 8th largest trade nation in the world, Hong Kong, and they deserve the support. And we would be rather appreciative if they turn to the UK, not Canada, other countries, although they're very welcome in those as well. And we can obviously take very good advantage by looking after our Hong Kong citizens. So that's one question. Rupert from Invest UK, an associate of Sovereign, has suggested that the innovative visa is very much here to stay, which I very, very much welcome. And Invest UK Group is an endorsing body, so that's a friendly endorsing body. And ILR through the innovative visa can be acquired within 3 years, which is positive. So there's positive programs or positive criteria in all programs, although I did like the old-fashioned tier 1 entrepreneurial visa. Everyone else did as well. A question for our RPG friends. This has come from Hussein. How long will it take to register a UK branch of my overseas company? I'm reading through and reworking the question because he obviously wrote the question down very quickly. Thank you, Hussein. So it's about setting up a branch of an overseas company is the first question. I could have a stab at this myself, and Stuart could too, but Michelle or Paul, would you want to answer that, please?
Yeah, so that's setting up so it's not necessarily a limited company, it's where they've got a branch, some entity, well, a branch which they're trading through in the UK.
They want to set one up, they haven't done it yet.
Right, for setting up a limited company, I'll cover both actually. Setting up a limited company, it's a case of incorporating a company's house, and that the process of that is quick, instantly you can do that. Setting up a branch is registering with company's house again, so you would register that branch on another form, but setting that up can be done quite instantly.
The other part as well is the VAT registration, which we've not really covered today. If you've got a permanent establishment in the UK, that probably takes the longest out of the different parts, and that can take up to 6 weeks for an overseas trader, maybe a bit longer at the minute because of COVID times, but I hope that helps.
And on the same question from the gentleman, setting up a branch or a subsidiary, and I prefer a subsidiary, and they are wanting to have overseas employees relocating to the UK. Yes, it's possible, but just setting up a company alone or a branch doesn't give you any automatic immigration rights. So if they're EEA nationals and Swiss nationals, they can have pre-settlement and settlement possibly through to the 30th of June. Thank you, Lynn. 30th of June. But my advice is get the pre-settlement and settlement rights claim before Christmas, because that's technically 31st December is when we officially depart from the EU. And for non-EU nationals, you've got a tier 2 sponsorship visa, which the UK company can apply, and we've got details of that which we can send you. There is the possibility of the sole representative visa, potentially the innovative visa. So for non-EU nationals, they've got to look at the visas that are appropriate and relevant under the Home Office immigration controls and regulations. So that was one question. Now, question here, what are the implications for UK resident non-DOMs? That's a non-UK domiciled UK resident, possibly a person that's lived in the UK for less than 15 or less than 7 years. So a major advantage, and you know, that can be sustained. So make the use of that. I know who the question person is as well. Welcome to the webinar. But what are the implications regarding CRS, Common Reporting Standards? Well, there is no negative implications, but there are implications. And Paul and Michelle, would you like to have a go at answering that question? We've got to assume that I can tell you the person raising the question is UK resident, non-UK domiciled, and he's lived in the country for less than 7 years and naturally has overseas bank accounts. Would you please have a go at answering that to our questionnaire, please, Michelle?
So we've got a UK resident individual, which has been in the UK less than 7 years.
Yes.
A non-UK domicile.
Yes, and with overseas bank accounts with some nice accumulations.
So we've got the tax charge, which is potentially kicking in under the remittance basis charge, because we're hitting into the 7 out of the previous 9 years there. So the question which they were posing was...
Not yet at 7 years. I know this gentleman is
not yet at 7 years. So he's coming to that point. So potentially what we've got is when we're going over that 7 years, we're going into potentially the remittance basis. If they've been claiming the remittance basis of taxation, then you've got the remittance basis charge, which kicks in over the 7 years. Now, even though you've got the remittance basis charge that kicks in, you still can look at whether you're taxed on an arising basis or the remittance basis, and you look at that claim each year to see which one's more beneficial to be claiming.
Okay, Michelle and Paul,
we can advise further on that.
What is the implication of common reporting standards? It doesn't matter if Credit Suisse Zurich informs HMRC about an overseas bank account because he's UK resident, because he's not remitting income and gains into the UK. Yes. But there might be there would be a CRS implication, wouldn't there?
Potentially, yes, because you've got that overseas. Yeah.
Okay, so there may be common reporting standards apply to UK residents that are non-UK domiciled, minus less than 7 years, plus 15 years, but there is no requirement to report the person's overseas bank account unless he's bringing income and gains into the UK for the first 7 years, isn't there, Michelle?
That's it, but yeah, so that's it. The remitter, but if the income generated is, depending on whether they're in the tax system with a self-assessment system at the moment, because the remittance basis taxation is automatic if their income generated from that source is below 2,000. But if you've got income which is in excess of 2,000, you would have been making some form of election as to how you're being taxed. So that's where it just depends. We would have, of course, we could advise on that further, but it would all depend on what's happened over the previous 7 years and what they've been doing within the UK tax system.
Okay, thank you. And further information on, if anything arises from these questions, we can answer them offline and just put your questions to us. Now, the person representing a company that attracts Israelis and foreign startups to foreign markets, what can the UK offer to startups opening operations in the, I think that must mean the UK. So startups, again, I invite Paul and Michelle. You could look at an Israeli technology company in the fintech area. They're one of the world's best at that, and the world's best at a lot of other things too. And what, if they're coming to the UK, what can we offer them in startup capability? I've told them about free banking for 12 months. They've got the non-UK domiciled tax landscape, which is beneficial. But have a go at that, Michelle, and brief if you can, please.
R&D. So yeah, very much so. Yeah. So yeah, new startup, doing research and development or the technology activities, then yeah, we can, UK will offer good tax release for any qualifying expenditure on research and development. And also coinciding with that is the patent box regime as well, kind of later on when they start to generate some form of income from that IP.
I think just quickly, those two are the main parts to start with, but I think what Stuart was saying about the holding company structures, if you can get build a technology up in a company and then exit that company after 12 months in a holding company structure, there's no tax on the sale of those shares, and then you can reinvest again from a UK holding company to the next venture, and it just gives you a lot of flexibility, you know, in terms of, you know, how you build your value up over a period of time.
Absolutely. So on any overseas startup, ladies and gentlemen, we've still got the vast majority on the webinar that first registered and actually attended today. So thank you for staying on. We've only gone over a few minutes, and so you've got the holding company regime that can own qualifying subsidiaries, 130 tax treaties. There's no withholding tax on dividends being paid from a UK company to an Israeli company, a tax haven company, or a company registered in a jurisdiction that doesn't actually perform any trade with the UK by way of treaty and the like. And the R&D, research and development credits, is available to all scales and all sizes of company without prejudice, which is unique compared with a unique competitive edge, because other countries do it, we perhaps do it a little bit better. So again, keep your questions coming. I've dealt with the Hong Kong question thanks to our Home Office immigration specialist that's managed to sort of take a coffee and a sit down to answer that one. And any more questions on immigration and the like, again, you can keep submitting them through. There is, I believe, no more questions. The same question's been asked by, I've got a similar question, but that's already been answered. So we come to almost a close, ladies and gentlemen. There's still over half of you in the room of this wonderful webinar, and thank you very, very much for your undivided attention. You'll have the presentations delivered to you today or tomorrow before the end of the week. You'll have the contact details of Paul and Michelle. Thank you, associates, for your quality topics and delivery. You'll have the contact details of Stuart and myself, which you got in the presentation, and Team London or Team UK of the Sovereign Group remain at your disposal. Anybody needing the property webinar slides that we did a month ago, which I hosted along with Lawrence Lancaster, our Group Tax Counsel, that's quite a compelling read, and multiple case studies and illustrations. Please just let us know and we'll send it back to you. We have actually gone through 36 slides and did finish just after the hour, which I think is nothing short of a good effort. Again, thank you for your undivided attention. I don't believe there are any other questions. Suffice to say, thank you to Michelle and Paul at RPG, to Stuart and colleagues around the group that continue to support our webinars. We're going to put a series of these webinars on, not because there's just an uncertain COVID period, but a very good medium to keep our associates updated, spending an hour and a bit more on viable, useful topics. Those webinars are going to be announced on the website, our website, through Jess and Tiffany and Miguel. So thanks to our technology crew and our esteemed marketing executives for delivering pretty much a perfect presentation, and you to decide whether it's perfect or not. We'd love hearing from you on any questions, on any matters arising. Again, thank you again for your undivided attention. Thank you for your attendance, and I wish you, on behalf of all speakers, a very good day, and keep safe, keep well, and do think of us in the UK. You're very, very welcome. All the best.
Thank you.
Thank you.
Can we turn off